for example, if we go to website of Yahoo Finance and we'll see it at the same company and we'll see is there any difference in the ratios. And that would be the reason why some investors, they prefer to calculate it themselves. Okay, for example, the price, let's have a look. Price earning ratio 1048, and here price earning ratio 1047. Just okay, slightly difference. Wouldn't be that huge difference. Okay, sometimes maybe they calculate the higher price 35.39, 30, so it's all the same. And you can see first year target $42, earnings 3rd of November. So remember, it's not always good. Like it's better not to buy before earnings. Okay, just stay away of that. Earnings per share 338. Earnings per share. Okay, earnings per share 338. So it's exactly the same. So the information is currently like reliable. So when you check two different sources, you will at least know of share prices from Yahoo. Yeah, sometimes you will find mistakes. Like basically, because remember when you get information for free, it's not updated as fast as you would like it to be updated. All right. Sometimes in my case, when I open Yahoo, I don't see half of this. At the moment, I see options, but very often I don't see options. Sometimes I don't see competitors. I don't see any information here. Okay. So after you analyzed for example, using Finviz, okay, you can go to Yahoo Finance and look at this company in more details. The first thing which I'm going to go, it's income statement, because for us it's important how much money company is making. The good thing about this that you can see it's in annual or quarterly data. So okay, if we see that that's what we see, gross profit, and we can see that it was 3 billion, then 2.7 billion, and in 2014 it was 1.9 billion. Now you can see that the total gross profit, it's like total revenue as well. So we can see 11 billion, 9.9 billion, and 9 billion. So we can see that total revenue is sliding down, and gross profit is sliding down as well. And then if we look at like expenses. Okay, now total profit for some reason it's not here. Selling and general administrative expensive. They are growing. So revenue is going down, but the sales expenses, they went up. So from 473 million to 505. They were higher in 2013, but dropped down. And here, non-recurrent expenses as well. So if we look at net income, so that's what probably you'll be looking for, the total net income. We can see that 1.9 billion, then 1.8 billion, and now it's 1 billion. Absolutely, yeah. That can justify the share price drop. So we can see definitely that something is happening within that company because their profitability going down. Now, also it's important to look at quarterly data. What was happening during last 4 quarters? So what can we see here? That gross profit, it was 414 million, then 579, then 419, then 607. So we can see that actually there was a growth. Like if we look at September 2014 and June 2015, we can see that there definitely was a growth here. Okay, but if we go back to lowest part, so income, we also can see that it was 200 million, 360, 294, and then 390. So practically they doubled their profit within last quarter. Okay, and tomorrow will be earnings. not tomorrow, I mean, when we look at this 3rd of November, right? So it would be interesting to see how much money company made during that time. And again, another important part which you have to look at earnings which kind of, because sometimes they're seasonable. Maybe it's always in the first quarter makes less money than in the last quarter. Okay, maybe it's all the time this type of structure of movement. So you can calculate how much money company made. So it's 390 plus 200, so it's about what, 591. And here, so let's calculate it just for curiosity. So it would be 390 plus 294, 294 plus 360, 360 plus 201, 201. So it's 1.24 billion. So 1 billion and 240 millions. And if we look at the last year, it was 1 billion. So we can see. So it means that the profitability during 2015, it's went up, but the price is still sliding down. And maybe if we look at this in more details and we see that they're doing some improvements within the company, okay, which investors may be missing, okay, like I mean general investors on the stock market. And if you see that the company is acquiring certain position, and as soon as they get back to the same position which they had before, they might jump in price quite a lot. Okay, and maybe that's why some analysts they put in the target price for this company $45. So it's mean $10 up. So it's nearly 30% growth within next year, which is pretty impressive. Okay, so that's our income statement. The next one is balance sheet. Always look at balance sheet. So what happening is here, and again we can see it's an annual data or quarterly data. Okay, and for us it's important that company is increasing their assets value. All right, because it's like if you look at humans life, okay, for example your friend, and you have couple friends, and you met them 5 years ago, and after that you didn't see them for a while, and then you came and see and talk, oh, how's your life? And another one, first guy is saying, oh, I'm making money, like I'm making, for example, $150,000, working in a great job, etc., etc., etc. I am like traveling, I'm doing all this stuff, and etc. And he's like, where do you live? Oh, I'm still sharing my apartment with my friend because like basically I don't have any money left. And have you got a car? No, I don't have a car. I don't have a house. I have nothing. Whereas another guy, he might be making only $100,000, but when you talk to him, he already bought a house and maybe paid it half of it already, like mortgage paid. He's got a good car and it's fully paid. He's got some lovely musical equipment, some stuff, garage, maybe yacht, etc., etc., etc. And you can see how can you distinguish the wealth by how much person is making money or how much they have in assets. Okay, and that's how you have to look at the company as well, because some companies they're making good money, but then this money they just wasted somewhere. Okay, and that's what you have to have a look as well. So what we can see here in 2012, their total asset column was 16.6 billion, then 18 billion, then 18.2 billion. So we can see that assets growth was happening. Okay, and the best thing is to look at the last quarter, because balance sheet is nothing more like a snapshot of the current situation in the company. And we can see that it was 18.4 billion 4 quarters ago, and now it's 17.7. So it's reduced. Okay, but assets we always have to look with liabilities as well, and we can see that liabilities they increased. It was 7.5 billion and now it's 7.6 billion, so 100 million more. So we can see that assets were reduced by what, 800 million, and liabilities increased. So the company is in a worse situation than it was 4 quarters ago, okay, from balance sheet perspective. So they sold some assets and they had to take some extra cash to borrow. And one more important sheet is a cash flow statement. And again, we can see annual data and quarterly data. And cash flow, it's important for us where the money, like if company has a positive cash flow or negative cash flow. It's same as when people invest in like for example property, and some people get positive cash flow. And positive cash flow, what it means that if person for whatever reason lost their job, they are not in trouble because the property paid for itself, right? So they, for example, renting it and they're getting $1,000 a week, and their mortgage is $800 a week, so they're getting $200 in cash. And even if they got fired, they still can keep this property, because if what happened if the property is negative, it would be the other way around. So if the person lost their job and they have mortgage which has to pay like $1,200 a week, and their property gives them only $1,000 a week, it means that they have to add $200. And if they don't have a job and don't have any income, they just cannot provide it. So they might lose the property. So that's why it's so important to have cash on our account, first of all. And we looked at this particular company. We saw that they have, like, if we go back to balance sheet, how much cash we have here. So cash and cash equivalent, we see that it's 2.3 billion here. So it's quite a lot of cash in any way we have. So it's important to have. And also, if we look at total assets, 18 billion and 7.5 billion. So it's like good one. And also we look at current liabilities. So total current liabilities 1.6 billion and total current assets 5.3 billion. So they're pretty strong position from cash position. So they have a lot of cash on their account. So even if they have negative cash flow, they still have some cash to go like ahead and run the company. Okay, let's have a look. What's their cash flow? All right, so we can see that for the last 3 years it's negative. So it's 95 million, 113 million, and 2.9 billion dollars. So they're negative. And here you can see the where the money went. So if you look at operating activities, it's positive. But when you look at investing activities, okay, it's negative. And financial activities negative as well. So that's where the money. So they invest money and financial activity. So they purchase stock. So 2.7 billion. It's actually went to buy the stock. So it's not that bad. So if you take the total negative cash flow 2.9 billion, you know that practically 2.7 billion was spent to buy back stock, which is good because less shareholders means that you own more in the company itself. And then we can see that part of this money are also dividends. So they're paying dividends. So it's not that bad. If you deduct these two parts, it probably would be a positive cash flow here. Okay. And then I looked, like personally, you always look at competitors. And here you can see some companies, majority of them private. And here it's in general in industry. So if we look at ratios, price earning ratio here 10, in average in industry is 12.8. PEG here is non-available, it's 1.2. Price to sales 1.3, here 1.3 as well, so practically the same. So I wouldn't say, based on that, I wouldn't say that this company is undervalued. Okay, and of course I would have to have a look more in details in this one. The next